EPK Capital presents Deep Dive on Titan Company. What if one of the biggest success stories of the TATA Group didn't even carry the TATA name at the start? And what if its most profitable business, jewelry, was an almost accidental diversification? Today, a deep dive is taken into Titan Company, a stock that has delivered over 75,000% returns since its all-time low. But the real question is, after such a phenomenal run, is there any value left for investors today? The company snapshot, more than just watches. Titan Company stands as one of India's most respected lifestyle companies, a joint venture established in 1984 between the illustrious Tata Group and the Tamil Nadu Industrial Development Corporation, TDQ. While its origins are in watchmaking, its modern identity is defined by a diverse and powerful portfolio of brands that touch many aspects of a consumer's life. The company's business is segmented across several key verticals. Jewelry. This is the undisputed crown jewel of the company. Brands like Tanishq, the luxury offering Zoya, the workwear-focused Mia, and the digitally native CaratLane make Titan the largest branded jewelry maker in India. This segment is the primary engine of growth and profitability, contributing over 85% of the company's total revenue. Watches and wearables. This is the legacy business where it all began. Iconic brands such as Titan, the youth-focused Fastrack, and the mass-market Sonata have made the company the fifth largest watch manufacturer in the world. Eyewear. Through its Titan Eye Plus brand, the company has established a formidable presence in India's organized eyewear market, offering prescription glasses, sunglasses, and lenses. Emerging businesses. Demonstrating its ambition to become a comprehensive lifestyle brand, Titan has ventured into new categories. These include Tanira for ethnic wear and saris, Skin in the fragrances segment, and iArth for women's handbags. Titan's history is a compelling lesson in strategic evolution. It began its journey as Titan Watches Limited in 1984, with a clear focus on manufacturing quartz watches. The pivotal moment that would redefine its future came in the mid-1990s with the launch of Tanishq. This foray into the jewelry market was not just a diversification. It was a transformative strategic pivot that capitalized on the vast, unorganized, and trust-deficient nature of the Indian jewelry industry. This single decision is the primary reason for Titan's current scale and market dominance. Other key milestones have cemented its position. The launch and subsequent repositioning of Fastrack as an independent youth accessories brand captured a new demographic. The entry into eyewear with Titan Eye Plus in 2007 was another successful application of its brand building and retail expertise to a fragmented market. More recently, the multi-stage acquisition of CaratLane, culminating in a 98.28% stake, was a strategically crucial move to secure leadership in the fast-growing online and omni-channel jewelry space. The promoter structure of Titan is a key pillar of its strength, being a joint venture between the Tata Group, through its principal holding company, Tata Sons, and TDQ. The backing of the Tata Group is an invaluable intangible asset. It extends far beyond capital. It signifies a commitment to the highest standards of corporate governance, ethical business practices, and long-term stakeholder value creation. This trust premium is particularly potent in the jewelry business. In a market where consumers are deeply concerned about the purity of gold, fair pricing, and transparency, the Tata name acts as an unparalleled guarantee. This has enabled Tanishq to not only command a premium, but also to spearhead the shift of consumers from the unorganized local jeweler ecosystem to the organized branded sector, a fundamental driver of its long-term growth. A lesser-known but interesting fact is that TDQ remains the single largest shareholder, a testament to the success of this enduring public-private partnership. The financial story, a decade under the microscope. A company's narrative is compelling, but its financial performance reveals the true substance of its operations. An analysis of Titan's consolidated financials over the last 10 full fiscal years, from 2015 to 2025, uncovers the engine of its growth and highlights key trends for investors. Titan's growth over the past decade has been nothing short of exceptional. The company's consolidated revenue grew from our 11,913 crores in fiscal year 2015 to our 60,456 crores in fiscal year 2025. This represents a compound annual growth rate, CAGR, of approximately 17.6%, a figure that significantly outpaces India's nominal GDP growth over the same period. This top-line expansion has translated effectively to the bottom line. Net profit surged from Rs 816 crores in FY15 to Rs 3,337 crores in FY25. The profit CAGR of around 15.1% demonstrates a consistent ability to scale its business profitably. A notable dip in net profit was observed in FY21, which fell to Rs 974 crores, a direct consequence of the widespread lockdowns and suppressed discretionary spending during the COVID-19 pandemic. However, the powerful V-shaped recovery in the subsequent years, with profits crossing Rs 2,000 crores in FY22 and Rs 3,000 crores in FY23, underscores the resilience of its brands and the strong pent-up demand in its core categories. Despite operating in a sector with a highly volatile key raw material, gold, Titan has demonstrated remarkable consistency in its profitability. The company's operating profit margin, OPM, has remained in a stable band, largely between 10% and 12% for most of the decade, with predictable dips during challenging years like FY16 and the pandemic hit FY21. This stability points to significant pricing power, allowing the company to pass on fluctuations in input costs to consumers and strong operational efficiencies, such as its famed gold leasing model that mitigates inventory price risk. Similarly, the net profit margin, NPM, has consistently hovered in the 5.5% to 8% range. This indicates a disciplined approach to managing expenses and taxes, ensuring that revenue growth consistently translates into shareholder earnings. A critical trend to emerge from the financial analysis is the changing structure of Titan's balance sheet. The company's debt-to-equity ratio, a key measure of financial leverage, has seen a significant increase. It stood at a negligible 0.03 in FY15 and FY16, but has climbed steadily to reach 1.79 by the end of FY25. This rise in leverage is not a sign of operational distress, but rather a direct consequence of a deliberate and strategic capital allocation decision. The most significant driver of this increased debt was the funding for the final stage acquisition of Carrot Lane. In 2023, Titan spent Rs 4,621 crore in cash to increase its stake in the online jewelry platform to 98.28%. This move reflects a strategic shift, where management is willing to use the balance sheet more aggressively for inorganic growth to consolidate its market leadership, particularly in the crucial online channel. The table on the left provides a clear, at-a-glance summary of Titan's financial journey over the past decade, condensing its performance into key metrics that form the basis of this analysis. Valuation: what's a fair price for Titan? Titan is clearly a high-quality business with a strong growth track record. However, as investors know, even the best company can be a poor investment if the purchase price is too high. Therefore, a critical part of the analysis is to assess its valuation from multiple perspectives. The technical picture painted by its stock chart, a fundamental valuation using a classic formula, and its standing relative to peers. A look at the long-term price chart of Titan's stock reveals a powerful and consistent uptrend over the last decade. This is the visual representation of a multi-bagger stock and a true long-term wealth creator, with a 10-year price total return of an astounding 998.8%. However, zooming in on the medium-term chart of the last 1 to 2 years tells a different story. The stock has entered a phase of consolidation, trading within what technical analysts call a horizontal trend channel. This sideways movement suggests that while the underlying business continues to perform, the market is pausing to digest the stock's high valuation. During this phase, key technical levels to watch are support. The stock has found a floor of buying interest in the range of R3400 to R3600. Resistance: the upside has been capped near its all-time high of approximately R3187. The current technical posture indicates a market in equilibrium. A decisive breakout above the all-time high resistance would signal a continuation of the primary uptrend, while a breakdown below the support zone could warn of a deeper price correction. The Benjamin Graham formula, a value investing litmus test. To get a sense of the stock's intrinsic value from a classic value investing perspective, the Benjamin Graham formula can be applied. It is important to preface this exercise with a significant caveat. Graham himself was deeply skeptical about forecasting future growth rates and warned against using this formula for precise valuation, a point often overlooked. This is best used as a theoretical tool to gauge valuation, not as a definitive price target. The formula yields an intrinsic value of approximately Rs15.17 per share. Compared to the current market price of around R3600, this suggests the stock is significantly overvalued from a traditional value investing standpoint. This highlights the limitations of applying such a formula to a high-growth, high-PE company, as it is extremely sensitive to the growth input and was designed for more stable, mature businesses. The investment thesis: the bull versus bear debate. The analysis reveals a classic investment dilemma: a high-quality company trading at a high valuation. This brings us to the central debate for any potential investor. It is essential to weigh the compelling reasons for optimism against the significant risks and reasons for caution. 1. Unmatched brand equity and market leadership. Titan, primarily through its Tanishq brand, is the undisputed leader in India's organized jewelry market. It holds an 8% share of the total Indian jewelry market, which is a commanding position in such a fragmented industry. This powerful brand equity creates a deep competitive moat, allowing for premium pricing, fostering immense customer loyalty, and ensuring repeat business. 2. Structural growth story. The Indian jewelry market is in the midst of a multi-decade shift from the unorganized to the organized sector. This formalization is driven by changing consumer preferences towards transparency, certified purity, and a modern retail experience. As the market leader, Titan is the single largest beneficiary of this structural trend, providing a long runway for sustained growth. 3. Successful diversification and new growth levers. Titan is not a one-trick pony. The watches and wearables segment continues to perform strongly, providing stable cash flows. The strategic acquisition of CaratLane has given it a dominant position in the crucial online jewelry channel, capturing a younger, digitally savvy customer base. Furthermore, the company's international expansion, particularly taking the Tanishq brand to the US and the Middle East, opens up a massive new addressable market and represents the next major growth engine. 4. The TATA Premium. The backing of the TATA Group is a cornerstone of the bull thesis. It provides unparalleled stability, access to capital, and a standard of corporate governance that is a benchmark in the Indian market. This significantly reduces investor risk and builds a foundation of trust that is difficult for competitors to replicate. 1. Sustained high valuation. The most significant risk for Titan is its valuation. The stock is priced for perfection, with a PE ratio hovering near 87. This implies that the market has already factored in years of high growth. Any disappointment, whether from a temporary slowdown in the economy or a slight miss in quarterly earnings, could trigger a sharp derating of its valuation multiple, leading to a significant correction in the stock price. The high PEG ratio of 5.62 also suggests the price may have outrun its near-term earnings growth prospects. 2. Vulnerability to economic cycles and gold prices. Titan's core products, jewelry and premium watches, are discretionary items. Their sales are highly correlated with consumer sentiment and economic health. A significant economic downturn would almost certainly lead to a slowdown in demand. Additionally, while the company manages gold price risk effectively, extreme volatility or a sharp, sustained rise in gold prices can act as a short-term deterrent for consumers, impacting sales volumes, intensifying competition. While Titan is the leader, it is not immune to competition. Other organized players like Kalyan Jewelers are expanding their retail footprint aggressively. Simultaneously, a new wave of online-first, venture-funded brands is emerging, targeting specific niches and younger consumers. This rising competitive intensity could put pressure on market share and margins over the long term. Rising leverage. The recent increase in the company's debt-to-equity ratio to 1.79 marks a departure from its historically conservative balance sheet. While this debt was taken on for the strategic Carrot Lane acquisition, it introduces a new element of financial risk. Higher interest expenses could weigh on profitability, especially in a scenario of slowing revenue growth. Conclusion and disclaimer. The analysis of Titan Company presents a clear picture of a premier business with a complex investment case. On one hand, it is a phenomenal company with an almost unassailable brand moat in a structurally growing market. It has demonstrated a consistent ability to execute, innovate, and deliver growth for decades. This is all underpinned by the impeccable governance and long-term vision of the Tata Group, making it a benchmark for quality in the Indian market. On the other hand, the market is fully aware of these strengths. The stock consistently trades at a steep valuation that prices in years of high growth, leaving very little margin for error. The business remains exposed to the cyclicality of discretionary spending, and its balance sheet now carries a higher level of debt than it has historically. For a long-term, patient investor with a belief in the India consumption story, Titan remains a quintessential core portfolio holding. The investment thesis is a bet on the power of compounding a high-quality business over many years, even if the entry price is high. However, for investors with a shorter time horizon or a stricter adherence to value investing principles, the current price offers very little margin of safety. The risk-reward proposition at these levels is less favorable, and a significant market correction could provide a much more attractive entry point. Ultimately, the decision to invest in Titan hinges on an individual's investment philosophy. Is one willing to pay a premium price for a premium company, trusting that its quality and growth will eventually justify the cost? This content is for educational and informational purposes only. It is not intended to be and should not be construed as financial, investment, or legal advice. The views expressed are based on publicly available information as of the date of production and are subject to change. Investing in the stock market involves significant risk, including the potential loss of principal. Always conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions. And that's all we had for this video. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next. Thanks for watching.